Yo, what's good people? Hopefully you're all having a great trading day. I thought I'd do a little video and it's going to be an educational breakdown on how you can plot levels on your charts. And you know what, it might seem scary, however this is a very powerful tool, and it's simply aligning time frames and being able to align time frames with structure and being able to take trades off structure as well as taking trades off mapped levels. Now what I mean by that is when institutions and banks and stuff trade, they obviously want to be trading into higher probability areas which have had many reactions from in the past. Looking at this chart, you can see I'm on the weekly, and the weekly has had many touches around this level as well as this level. We've had then the higher reaction of this level, and we've had reactions of this level. So what this is what we'll call supply and demand. Now supply and demand is basically support and resistance, but it's a little bit different. The whole difference is the way that the banks and institutions use these levels as areas of interest for them to trade off. Now supply and demand is really levels where there's going to be a stacked amount of orders. So for example, right here, this is going to be a high demand area, and there's going to be a lot of buy orders around this level, and you can see that there's high demand around this level because you can see when the wicks come into these areas and they come into these levels of interest, there's an instant reaction, there's an impulsive move off these levels. Now the next area of demand would be this level right here, because if you can see, every time we've come into this level, there's been a move off this particular area. So you can see where I'm going with this. Now obviously there's going to be buy orders here, there's going to be buy orders here. Now if we're at the top of the market, what is there going to be? There's going to be sell orders. So now right here, this level is another structural level of supply. Now supply is just abundance of sell orders where people are going to be looking to take sells within the market to put it down. Again, this is another level where I felt the market can potentially sell through. So with that being said, let's quickly go ahead and break down higher time frame alignment and how it's so important to be aligning time frames with structure to go ahead and take trades. So without further ado, let's get straight into it. So I've already marked out the weekly, the daily and the 4 hour. So I always mark the weekly in these types of boxes. I will mark the dailies with these just vertical lines, and then I will mark the 4 hour with these kind of dashes. Now you can apply this with further time frames, even the 1 hour. However, for this type of supply and demand levels, I just typically do the weekly, the daily and the 4 hour, because I think that just gives the best kind of overlap and confluence. But you can go through all time frames and mark up, but I feel like when you start dropping down to maybe like the 1 hour, it becomes more into the region of support and resistance, which again is kind of different to supply and demand because it's going to be less orders there. It's just more of psychological levels where people are just kind of battling between these types of areas, if you will, for support and resistance. Now let's quickly go on the daily. So the daily, I've marked off this level, and again, if the reason being that we can see there was a reaction here, reaction here, so say if you used to miss the original impulsive move of these levels, right, there is another level on the daily which you can then use to take advantage of. Now again, if you can see right here, we can wick into this level is then meted onto the daily, and again, you don't have to take exact snipers off here. You can wait maybe for this leg, or you can wait for this leg, and even if you took trades off here, we just do stops. Do stops right here, or even stops below if you really want to be safe. This is that is a big stop there. But again, if you want to do a safe stop, right, and just take an entry on a daily, you can take this here. Now, the whole idea of aligning time frames is you want to be able to pinpoint areas and then cycle through. And really, so say we had this level marked up, right, and we know that it's a particular level of interest for us, we can then look at smaller time frames and see if we can refine that entry to get smaller stop losses possible to maximize our risk reward. And that's the whole ideal of trading. That's the whole idea of what trading is about. It's about looking at high probability areas which have had reactions from in the past, aligning them with other confluences throughout weekly, daily, 4-hour, and then being able to cycle through, drop down onto like 15 and 1 hour, and then refining it as tight as possible, where we are still being smart with our stops, but we are really fine-tuning the profit. And this is why this strategy is so powerful. And I would drop down into the 4-hour, where we can kind of elaborate what I kind of mean. Now, we'll do current price, right, or this kind of run up right here. If we look at how this price reacted into our weekly level, we can see that what trend is this in? We have a low, we have a high, we have a low, we have a high. I won't call this a high because it's matched here. We have a, what is this? Yeah, we have a higher low, we get a high, pullback, kind of a higher low to a higher high. Now this reversed, and again, this structure, you could have took trades, maybe you could have found trades on the 1 hour and still traded longs on this overall level. Or what you could have done is you could have waited. You could have waited for the confirmation of the overall trend, for the uptrend. Now, what I mean by that is, if you look, at this level, right, this type of supply level I have here, right, you can see the majority of the times price has come through and failed to kind of break this level. So when price then breaks through this level, right, if we look in the past, there's been a breakthrough and an instant reaction down. So what we could have done is we could have sat there and waited for our moving averages to start crossing. When price starts coming above the moving average, and then we start seeing price come away from our weekly area and come into our daily area, and then break away from our daily area and then start coming up into our 4-hour area, we can then look at this as the potential confirmation of this being an uptrend. And now what can we do? We can align fibs, nice 61.8 retracement, and then we can drop down further, see if we can get finer entry refinements. So say if we got into trade here, right, we can just do straight under this low, right, 12 pips, ride it all the way to 1. Right, now that's 7R. That's 7R if you just held it to 1, not including taking partials along the way if you want to take partials. But that's 7R of a reasonably easy setup, just being able to match time frames, overlap them, and being able to kind of look at structural levels within these types of time frames again. So hopefully this was interesting. If you want me to go ahead and just do another breakdown of this type of trading, let me know. But yeah, that is all for this one, and I will catch you in the next one.